Hello everyone, welcome to Options Discovery on John Lothian News' The Spread. My name is Esma Awas and I'll be your host throughout the series. In this episode, we'll be talking about a few topics that newer and intermediate traders should familiarize themselves with. This includes multi-leg option strategies, volatility, and corporate actions. Later, I have a chance to sit down with Mark Benzaquen, principal of OCC Education. Mark is a veteran in the options industry and dives deeper into this episode's topics. Let's start this episode by talking about some of the strategies a trader can use once they have a grasp on basic calls and puts. Before getting into specific strategies, let's talk about debit and credit spreads. A credit spread involves selling or writing a higher premium option and simultaneously buying a lower premium option. The premium received from the short option is greater than the premium paid for the long option. On the other hand, a debit spread involves buying an option with a higher premium and simultaneously selling an option with a lower premium. A debit spread results in a premium debited or paid by the investor. One multi-leg strategy that results in a net debit is a bull call spread. On the other hand, a bear call spread results in a net credit. A bull call spread consists of a long call with a lower strike price and a short call with a higher strike price. Profit is maximized if the stock price rises above the strike price of the short call at expiration, and loss is capped by the net debit if the stock price falls below the strike price of the long call at expiration. The goal is to profit from a gradual price increase of the underlying stock. A bear call spread consists of a short call with a lower strike price and a long call with a higher strike price. Potential profit is limited to the net premium received, and potential loss is limited to the difference between strikes minus the net credit received if the stock price rises above the strike price of the long call at expiration. The goal is to profit from a neutral or bearish price movement in the underlying stock. Volatility is also another topic that traders need to familiarize themselves with when establishing positions in the market. Trading around volatility can really depend on the individual investor's sentiment. Some traders prefer to sell options if they believe the underlying price will decrease. Other traders might see heightened volatility as an opportunity for the market to go higher. In this case, traders could choose to buy more options. In general, when trading around volatilities, traders should understand their own risk tolerance, how the Greeks are affected by volatility, and establish a few strategies they could use based on their market sentiment. Let's talk a little bit more about corporate actions and why a trader needs to keep an eye out for them. Some of the most common corporate actions are dividend payouts, stock splits, and mergers and acquisitions. Dividend payouts are not uncommon occurrences for underlying stock. If a trader wants to capture a dividend, then they might be forced to exercise their option before its expiration date. In this case, a trader might lose some of the time value that exists in the original contract. Stock splits would cause an increase in volume in the original contract. Let's say you have one $100 call option and the underlying stock goes through a 4-for-1 stock split. Now you will have 4 $25 call options. Later in the episode, we'll go deeper into how these corporate actions affect options pricing. We'll also get a chance to talk more about how mergers and acquisitions affect options. This week, we're lucky to have Mark Benzaquen, principal of OCC Education, to talk more about multi-leg strategies, volatility, corporate actions, and more. Without further ado, please enjoy this week's episode. Hello everyone, welcome to another episode of Options Discovery. Today I'm sitting down with Mark Benzaquen. Mark, can you tell me a little bit more about your background and how you got to where you are today?
Yeah, certainly. Well, I've been in the business now for 25 years. I got started back in 1997 on the floor of the CBOE. Like a lot of people at that time, it wasn't what I knew, but who I knew that made the difference. So in this case, my at the time brother-in-law was a trader in the S&P 500 pit, and he got me on the trading floor, and I was able to find a job as a clerk, kind of moved my way up through the ranks. On the market making side, in 2000, I went out to San Francisco to work on the Pacific Coast Exchange there for a bit. Came back to Chicago and then got on the brokerage side, and I spent the better part of the next 15 years or so at CBOE at that time as a broker in some of the trading pits, the indices, the NASDAQ and the Russell specifically. From there, 2015, I left the trading floor and I was looking to get into teaching. because it's something that I kind of had a passion about, something that I felt interested in. And OCC came calling, the Options Clearing Corporation. They have an educational arm called the Options Industry Council, or OIC. And so I've been with them now since January of 2016. And it capitalizes on not only my financial background, but my interest in educating. So that's where I came from. That's where I am now. And honestly, things couldn't be better.
And as someone who leads a lot of these educational programs and webinars, what is something most newer options traders tend to overlook when they're getting started in the industry?
Yeah, certainly. The thing that they most overlook is kind of running before they really learn how to walk. And I'll use an analogy or maybe a metaphor. Back in middle school, when I graduated middle school, for my graduation, my mother bought me some drum lessons. I had always wanted to be a drummer, so she got me, I think, 6 months worth of lessons. And after that 6 months, me being a 13-year-old, thought I knew everything I needed to know. And I stopped taking the drum lessons and, kind of figured everything out on my own as I went. But the point is, had I continued those lessons and had I continued more formal training, like, getting into school band or, something like that, I would have developed much more quickly and I think much more efficiently as a drummer had I continued those lessons. The way that it applies to options is kind of the same thing, that the individuals that I speak with that know the basics of calls and puts, or maybe a handful of strategies, think that they have everything down and that they know that all there is to know, and don't continue with that education, don't continue to try to learn. Rather, they simply apply the lessons that they already know to their trading, and they wonder why aren't they as successful as a trader as they want to be. So the number one mistake, I guess, that I would say that I see people making is not taking that education further and not trying to learn more, rather than just making mistakes and learning from that.
And just, I guess, ask a related question. What kind of mindset do you think is most beneficial for traders to have when they're getting into the industry?
By getting into the industry, you mean getting into trading, I'm assuming. So for people that are just beginning to trading, their mindset needs to be um, caution, for lack of a better word, learning to walk before you can run. The way that we always talk to investors now, the one thing that I should clarify is that because I'm not a registered representative, I don't make recommendations or provide advice. So the ideas and thoughts that I convey are my own. But that being said, people need to start small. You're not going to begin trading these, multi-legged iron condors or, iron butterflies, something like that. Or you're not going to be trading 1,000 contracts at once. You're going to start small. You're going to buy a call, or you're going to buy a put, a single contract or something like that. And the idea is that you want to give yourself time to learn how these things are going to work. If you can find a paper trading platform, for example, that's a terrific way to learn. We used to have one on our website that unfortunately went away many years ago. We are hoping to bring it back later this year, but the idea is the more practice that you can get before you're really plunking down your hard-earned money, I think the more successful you'll be as a trader and the better experience that you'll have as doing such. So the mindset needs to be, I'm not going to get up to the plate and hit a home run every single time. There's a difference between trading and investing. To me, trading is just that. You swing as hard as you can and you try to hit a home run every single time. Investing is you just want to get on base. It doesn't matter if you hit a single, if you get hit by a pitch. You just want to generate small returns, but generate them consistently to where hopefully you'll have a successful endeavor in trading in the industry.
And I want to go back to some of your work, actually. Can you tell me a little bit more about the 9-course curriculum that you launched with the OCC? What do these courses accomplish, and how do they help options traders?
Yeah, certainly. So OCC Learning is the program that you're talking about. It is currently a 9-course curriculum that begins with an introduction to capital markets. You know, what is stock? What are options? Talks about the regulators. Moves on to Options 101, the terminology. Options premium, what is it and how is it derived? What is the exercise and assignment process, et cetera. So it's 9 courses currently that kind of go from the very beginning, from the very basics of options and work their way up. Options are a lot like math is something that I'd like to say. You know, first you begin with addition and then you build on that and you go to subtraction and et cetera, et cetera. And options are kind of the same way. You learn the basics and the building blocks, and every lesson that you learn builds upon the previous lesson that you had. So all of our courses are designed from the ground up, beginning with the basics and moving through more advanced material. The course that we just launched recently deals with synthetic options, which is a very advanced topic. So it kind of runs the gamut from A to Z in terms of options from an educational standpoint. We don't tell you this strategy, you know, you should use if you're bullish, or this, you know, this stock you should, you know, trade covered calls on if you're, you know, expect a stagnant market or something like that. So none of it is from an advice or recommendation standpoint, simply from education, how things work, what you might expect, some pitfalls you may keep an eye out for, et cetera. It encompasses about 30 hours of coursework, which you know, certainly could take a lot longer depending on the individual. They can learn at their own pace. But it's something that we're very, very proud of, and it will culminate. It hasn't as of yet. I still need to create it, but it will culminate in a final exam where investors, once they do complete all the material, they can take the final to make sure that they've understood everything. Or on the other hand, is an investor can simply just take that final exam to see, kind of gauge, you know, what they're weak on, you know, what they should focus on with their future education.
When you mentioned final exam, my heart rate went up because I'm in college right now.
Right.
I'm always taking exams.
No, I may not look it, but I did go to college many, many years ago, and I do remember that. So you've got my sympathies.
Yeah. Well, thank you for sharing a little bit more about yourself and some of your recent work. I want to talk a little bit more about the actual options trading. So let's say that a trader has a grasp on how to trade options. From an educational standpoint, can you explain some of the multi-leg option strategies that they could be using to establish positions? And let's say that they're maybe bullish in the market.
Okay. When traders advance beyond buying and selling calls, or I should say buying calls and buying puts, when they get to that next level, they typically look to trade multi-leg trades, spreads. So the two types of spreads typically are debit spreads and credit spreads. Debit means you're paying for the spread. Credit means you're collecting. But the thing that more intermediate traders, the reason that they use spreads is because, well, there's really a number of reasons, but one of the reasons is, let's say you're bullish on a stock and you think the stock is, you know, got some room to move, so you buy a call option for it. Now, purchasing that call gives you the right to participate no matter how high that stock may go. And as there's no limit to stock prices, you're basically buying from, and let's say stock is trading $50. So you're buying the right to purchase that stock at $50 a share if you buy the at the money call. You're buying the right to buy stock at $50 a share no matter how high it goes. It could go to 500, it can go to 5,000. But what's the likelihood that that stock is going to go from 50 to 500 or 5,000 versus the likelihood of maybe it going from 50 to 55? That's certainly a higher probability. So what you're paying for when you buy that call option, you're paying for all of that room for the stock to go to infinity when maybe you only need a little bit. So by selling a call against the one that you purchased, you are enacting what we would call a debit spread, in this case, a bull call spread. So you're still bullish, you still want the stock to go up, but you don't think it's going to go to infinity. You only think it might go to 55, for example. And by selling that $55 straight call, you're collecting a premium. So instead of buying that $50 call for maybe, let's say, a $3 premium, you can sell, in addition, you can sell the $55 call for a $1 premium. So now your risk in the strategy is $2 versus $3. So you've reduced your risk by a third. You have reduced your capital outlay by a third, but you're still benefiting from that expectation in the stock price going up. The downside to it is if stock does go above that short strike, if stock does go above 55, now you're not going to participate in that. So that's kind of how a debit spread works. A credit spread would be the opposite. So if I bought that debit spread and you sold it to me, I would have the 50-55 bull call spread. You would have the 50-55 bear call spread. So when it comes to buying options, my risk is limited to what I pay. When it's selling options, my reward is limited to what I collect. So for me, the most I can make on that spread would be $2. For you, I'm sorry, the most I could lose on the spread would be $2 for me as the buyer. For you as the seller, that would be your profit. So spread trading is something that people get into once they've mastered the basics of, buying calls and puts. They start to look into credit and debit spreads, which I think is it's a wonderful trade to step up from those very basics.
So I like the breakdown that you gave. Are there certain strategies that a trader could use, maybe if they're more neutral on the market?
Yeah, that typically would come from selling. When you're buying something, when you're buying an option, you need that stock to move, right? If I buy a $50 call and I pay $3 for it, I need for that stock to at least to get to $53 by expiration in order for me to show a profit. Now, there's some other things that can happen in the interim. Implied volatility, for example, can change, and I could realize a profit from that way if implied volatility increases. But from a neutral standpoint, for example, when you sell an option, you really don't. You either want the market not to move at all, or you want it to move in your favor. So for neutral markets or range-bound markets, we're typically talking selling options. That could be a credit spread. It could be an iron condor, for example, which is a combination of two credit spreads. But what you're looking for is for the contract to expire without value, meaning that you don't want the other side of that trade, you don't want them to exercise their contract. So if the spread you're selling, or if it's just a straight call or put, if you were selling it and you if that contract expires without value, the premium you collected, you retain 100% of. So for a neutral market or neutral strategies, that's typically going to be selling options.
And I know you were talking a little bit about volatility, which I know can be kind of an intimidating subject for newer or intermediate traders. So
Absolutely.
How should investors approach trading options in volatile markets?
Excellent question. And the reason it's an excellent question is because there's really no easy answer. Every investor is different, just like every person is different. Everyone likes different things, different styles, different tastes. Investing is the same because people are going to have a different risk tolerance. People are going to have more or less capital that they're able to risk or willing to risk. So in volatile markets, there are a number of investors that simply stay away from trading like that. Something that comes to mind, for example, is earnings season. So if there's a stock that has earnings, you might see these big swings that come out as a result of the earnings announcements. Now, some professional traders that have been, trading for 20 or 30 years, absolutely refuse to trade around earnings because of that uncertainty. Whereas other traders are trying to capitalize on that uncertainty. They see a potential availability to profit. So as we approach a volatile market, whether it's a specific stock or just markets in general, different investors are going to approach it in a different way. If you think that the market is volatile, that might mean that the implied volatility of the option is high. If that's the case, you might see a lot of sellers, which doesn't really make sense, because if there's uncertainty, why would you accept all of that risk? But a seller may see the opportunity, saying that implied volatility is really high right now, and there's a I can't think of the word, but there's a phrase called revert to the mean. And what it's basically saying when it comes to implied volatility is where the implied volatility is historically, it will eventually get back to. And that's either, rising back up to that level or falling back down to that level it was. So if implied volatility is high, there may be investors think that volatility is going to revert back to the mean. Implied volatility is going to decrease, therefore option prices will decrease. So if I sell an option at $5, there might be an opportunity for me to buy it back somewhere down the road for $2. So volatile markets, some people might be sellers. Other people might look at volatile markets as an opportunity for the market to go even higher, and therefore they're buying options. And I know that's not really a clear answer one way or another, but that's how the market is. There is no clear answer because not everybody has the same mindset, not everybody has the same risk tolerance, and not everybody invests the same. But there are strategies specifically designed to either capture increases in implied volatility or decreases in implied volatility. And those are typically strangles, straddles, butterflies, things like that. So there are strategies out there. And just let me backtrack for a second. But all of this kind of brings up what's fascinating about options is that they're so versatile, they're so flexible that they can meet, or I should say they can potentially meet, as they're designed to meet any number of objectives that an investor has, any one of a number of forecasts that an investor has. When smartphones first came on the market, you remember the Apple Store, the app store that they had, and they had commercials basically saying whatever it is you're looking for, there's an app for that, right? And options are saying kind of the same way. Any forecast that you have, any objective that you have, chances are there's a strategy designed to meet those forecasts and objectives. So a terrific product can be used in any number of circumstances, including volatile markets.
I hope today's episode got you interested in going beyond the basics of options trading. I want to say a special thank you to Mark Benzaquen for taking the time to talk with us. Thanks for watching, and I'll see you all in the next episode. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.